Welcome to the HC Insider Podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. Over the last decade, private equity has provided a significant source of alternative capital to the global commodities markets and generated significant success and individual wealth. However, alongside that, it's brought considerable debt. It's also changed governance for some organizations and changed operating models. There's also on occasions been disconnects between the volatility inherent to the commodities sector and expectations of investors. Beyond that, there's sentiment that private equity might be responsible for bubbles in the commodities industry. In particular, at the moment, there's discussion around private equity's role in creating and possibly propping up questionable economics in shale extraction in North America. Today we're going to discuss private equity, the good, the bad and the ugly, with David Port. David is a partner at TDI Capital Advisors, an advisory business that works with alternative investors in the commodities sector and beyond. And David is a well-known and well-respected figure in the commodities industry. David, thanks for joining us.
It's my pleasure to have a conversation with you.
Fantastic. So I guess before we dig into some of the consequences of private equity, can you put a few definitions around what actually it is when we talk about that?
Yes, of course. I mean, private equity is a term that gets used lots and lots and lots these days, often in a disparaging way, which probably isn't fair. But really, it describes the process of allocating capital away from or not using the banking system. So I don't want to use the term shadow banking because that obviously is more of the unfortunate connotation, but it's really the mechanism by which private capital finds its way to investment opportunities. And it can either be via equity investment in private companies, equity investment in public companies that takes them private, or it can be on the credit side. And we're seeing more and more of that recently on the credit side. And so really it's the process of allocating capital to private companies.
And I guess more specifically, there's within the various jurisdictions, here in North America, you've got kind of that typical fund setup of the general partners and the limited partners and the tax advantages that go with that,
Yes, indeed. And those are have been and are still somewhat compelling. And you very often see, funds being created for fun's sake, which is unfortunate, but it does create a nice mechanism by which to become a fiduciary of someone else's money. But I would say that, the regulation around that structure is obviously lighter than it would be on the banking system. But nevertheless, it's a good vehicle and it's incentivized to be a good vehicle. It's a good vehicle to allocate capital and manage people's money.
And I guess before we go on, typically there's two ways in which the fund gets paid. One is by taking a slice of the assets under management, typically that 2%, typically, and then also the carried interest as well.
Yeah. So as a general partner, you'll charge your limited partners a management fee for being the fiduciary and all that entails, but also to the extent that there is performance, usually above a certain hurdle rate, then you'll collect a performance fee. And that's the carried interest that has the tax break that's made it such a popular vehicle.
So I guess over the past 15 years, it's been a tremendous vehicle for a source of alternative capital for the commodities markets. What led to that, and why have we seen such an explosion of this alternative type of investment?
Well, I think as it relates to commodities, the biggest catalyst for this was, as the banks in 2008 largely exited financing the commodities industry, except for, one or two notables who stayed in, like Citigroup, for example. Most banks simply didn't have the capital capacity to be able to put that risk on their balance sheet. So it was left to private individuals who may or may not have come out of those banks to start up on their own and create the funds to attract the capital to deploy it into commodities. So actually, it was a savior for the commodities industry, the fact that you could still attract capital when banks were retreating.
Yes. Yeah. Well, I guess we'll come on to that. I guess the other dynamic was as well, post the global financial crisis, was extraordinarily low interest rates.
Yes. Yeah, that will get us into some of the mechanisms and the investment processes that these funds have used. Yeah, what we call the hunt for yield was very much on after 2008 as market rates went closer and closer to zero, and frankly now continue to do so. We're going to see a bigger hunt for yield. And indeed, in my business, I see it ever more intense.
It's post the financial crisis. The commodities world is still booming. We're still at the top of that super cycle, all the way up really to 2013, 14. The traditional debt finance had dried up, and their private equity was around the globe, alongside other forms of investment, but bringing that much needed capital to the global commodities space. And that was truly, I guess, a global trend, was it, at the time?
I think you could view it that way, that some of the biggest funds operate in Europe and Asia, frankly, as well as in the US. So I think it's fair to say it became a global trend.
We're including in that bucket the sovereigns as well, effectively the same thing.
Yeah, I mean, sovereign wealth funds really operate on a similar basis. They allocate capital privately. I'm sure that, the fee structures are similar, or at least not dissimilar to what you'll see in the regular fund structures. And they also the sovereigns can also allocate capital to other funds. So, you get this network of co-investment that exists now as funds either allocate to one another or co-invest alongside one another.
Yeah, and I guess we even saw, and still do, the independently owned trading houses setting up their own internal funds as well. I mean, this was quite a popular enterprise throughout, the last decade.
Yeah, again, the vehicle is very, relatively simple to understand. The fee structures are very transparent, and for the manager with a track record and or a compelling investment thesis, it's an ideal structure.
And it's been a huge source of wealth and employment for those bankers and for other individuals in the sector globally, right? It's entering private equity has been the dream role for many individuals in the sector. Yes,
but I think there's a lot of mythology around that, just as there has been back in the day in 2006, 2007 about entering the hedge fund world, which really the structures of hedge funds are very similar to those of private equity funds. There's a lot of mythology, like you hear the golden stories of people that made incredible amounts of wealth for themselves by being good managers and making great returns for their investors. You hear the horror stories, the guys that didn't quite make it and got themselves upside down. But in the middle, I think there's a whole plethora of funds that did okay. People made a good living and created some wealth for them and their investors and for their portfolio companies. So I think, as with all these things, there's a lot of mythology around the business.
Because we should say as well, I guess, actually the principals of the fund are typically and have never been commodities experts, right? These are bankers, financiers who the point at which they employ commodities experts will be at the portfolio company level, the companies that they're investing in or building.
That's a great point. Some people are good at everything. And I've worked at large companies where the principal or principals can do everything from raise money to get into the weeds, on a structured transaction. But also, as you rightly point out, there are people that are very good at being fiduciaries and raising money. But when it comes to the content, subject matter of the investments, they don't have the depth. And that's where, frankly, and I'm thankful for this, that's where people like me who have been in the industry for 20 years, can assist and advise on on energy transactions that they want to put in their portfolio. But there is a skills gap there, which I think a lot of these funds recognize, which is why they have, the operating partner or senior advisor roles, which are available. And actually, I'm an advisor on a couple of funds in that way.
So I guess that's the good, right? It's been in a period when traditional sources of finance haven't been there. This has been a huge source of investment for the global commodities sector, which was booming. Alongside that, has created lots of opportunities for people. And I think part of it does sit at that expertise level and where that sits. But before we dig into commodity specific aspects of what we're going to call the bad side of private equity, there's some things that are common to all private equity. And I guess the first one is that it is a pretty standard model of, putting a lot of debt into the portfolio companies.
Yes. Yeah, again, as with it, I'll preface everything I say with, in any industry, any market, there are, the good actors and there are the bad actors. And I think, this is no exception. And there are the actors that have simply looked at the capital asset pricing model and the fact that if I lever a company, I can magnify my returns. And ergo, if the risk-free rate's 2% and I can lever this company, with a chunk of debt and create a 12% return, that's all well and good on paper. And in some cases, that does fuel growth in that portfolio company. But in some cases, all it does is it overburdens the company with debt that it can't service. And that's the unintended consequence.
I guess we should, at some point mention the fact that the whole reason, that the model of private equity is to flip the business, right? These are, on a 3 to 5 years typically. These aren't buy and hold. This is buy, do some conversions and then sell to someone else. And so you put that debt in, and often, as I understand it in my reading for this, because there was that hunt for yield that you mentioned, actually the investors, the limited partners in these funds, actually didn't have some of the normal protections and covenants that would have been in place for debt that would normally be there, because frankly, the funds were able to sort of, in quotes, charge what they wanted. So actually, you've not only encumbered these portfolio companies with debt, there's also relatively little, perhaps some changes in governance that would normally have been there as well.
Yes, I mean, again, and it's similar to the hedge fund industry. As a limited partner, you're reliant on your fiduciary to tell you what's going on in the portfolio. And you can take a passive role in that, or you can take an active role in that, as we're seeing now, as limited partners start to demand, a proper attention to social and environmental issues in the portfolio. But if you just take a passive role and accept the 15% return without asking any questions, I think you can find yourself in a problem.
We'll come back to that in a second, because I guess that's kind of the crux of where things have gone wrong. But one more aspect, and I'm keen to get your comments on this. I mean, the model is to run the business, lean, for free cash flow, boost EBIT, make it look attractive to the future investor. Has that gone alongside reducing some of the traditional, these are all heavy industries for the most part. Does that take an emphasis off things like health and safety, off investments like that, looking at externalities that maybe large public companies have to because they've got the shareholders there? Have we seen that darker side of the private equity world manifest at all, or is that me being unfair?
Again, I wouldn't say it's unfair. There are lots of instances where that model, creates real value. It fuels growth in the portfolio company and leads to great outcomes for everybody. But again, there's always the actor that just goes through the motions of levering it up, cutting the costs at any cost. In other words, health and safety takes a back seat in order to create a set of projections that make this company look like, it can be sold at a 15 times multiple and flipping it out, and then someone else picks that up and has to go restructure that company and add costs in again because they're breaching health and safety regulations. So look, there are always those examples out there, but I'm not sure it's a general theme. But again, there have been those stories of where people have pushed the envelope a little too far.
And I guess the real ultimate challenge is you acquire these organizations, and this is the specific to the commodities sector bit. You've encumbered them with a lot of debt. They're razor thin on the free cash flows. And that all looks great when, commodity prices, whether it's metals, whether it's coal, whatever it is, are marching upwards, and your, terminal or your producing asset, whatever it might be, is taking a lot of rent in. But inherently, the commodities markets are defined by their volatility. And I guess that's where, could you give us some examples of how does that then manifest itself in the private equity sort of story?
Well, when you talk about commodities, there is certainly volatility, but the nature of the volatility is such that it's firstly variable, and secondly, the price process tends to be monotonic. In that, and by that I mean we can set off in a particular direction, and we can keep going in that direction until weak hands are flushed out. And so we've seen that several times in the oil market, for sure. And though that introduces scenarios that I think people don't pay enough attention to, or at least don't. If they do pay attention to it, they don't have a plan to address it. It is always viewed as a rare event and an outlier. But you think about what happened in the oil market in March this year, and you've probably seen stories about how people are saying it's an outlier and you couldn't have predicted it, but actually you only have to look back to 2008 when it happened before. So it's still in the history, and it ought to be still in the scenarios that people run as they try and model acquisitions. But I do think the basic risk management practice of assessing a scenario and having a plan to address it has escaped many of the players.
Coming back, I guess, to the principals don't necessarily have the market risk expertise in commodities to be able to, I guess, make their Monte Carlo models more representative of the real world, right?
Exactly.
And one other thing is, I guess, also in the last decade, there's an argument to say that the velocity of change and cycling in the commodities markets has only increased. And you've had things that really haven't happened before, in the sense that we've now got a slew of commodities, heavy hydrocarbon commodities in particular, that are actually no longer really going to have an economic use over the coming couple of decades, right? Whether that's sort of, I don't know, making up, but heavy fuel oils, dare I say it, coals and so forth, where they're not even going to rebound. And these have been heavy areas of investment for private equity firms.
I agree. And I think it's very hard emotionally to recognize the fact, when you're sitting with a portfolio that's essentially betting on commodity prices going up, it's very hard to countenance the fact that and react to the fact that may not happen. I mean, coal's a great example. Thermal coal. I think anyone who has a projection or a set of scenarios where coal somehow recovers needs to look very carefully at that, because it seems to be such a low probability now that it needs to be recognized. And I'm sure that private equity firms that have a concentration of that commodity in their portfolios are going to have real trouble recognizing and acting on that, because it means it's almost catastrophic for them. Like, if you recognize that coal's not going to recover, what does that mean for your portfolio, and what does that mean for the returns that you're going to generate for your LPs?
And there might be a bigger catastrophe to come in the shale world, which we'll come on to in a second. I guess one more question. You've got these standalone portfolio companies that have a debt, and if there's any kind of downturn or they're relatively, I guess to use the phrase, they're fragile in that sense. And typically there's been a huge demand for talent, for management teams to come into private equity over the last decade. And in real hotspots, like we're going to talk in a minute about shale, but across the globe, in real hotspots, there's an argument to say that actually, where are these management teams coming from? They're coming from the large public companies. And in those companies, you're actually, as leaders, very rarely exposed to actually managing things like free cash flow and cash flow forecasts and a holistic business. And it also seems to me that a lot of these management teams, they're private equity, they get a really nice office, they rebuild teams to the scale and scope that they were used to within the public companies that they came from. And I don't want to sound too negative, but, and then, you've suddenly got to run this business for cash in really tight circumstances. And not many individuals have been in that situation either, right?
That's a great point. I've worked in public companies and private companies, and there is a difference. Like in a large German utility, for example, there's plenty of what I will call management buffer between you as a board member and, the people that have to manage the cash and manage the finances. It's almost like it's a machine that manages itself largely, to your point. But when you put yourself then into the private portfolio company arena where, because of the need to create value, you've cut overheads, right? And you've cut them to the bone. Suddenly, as an ex-board member, now, I don't know, CEO, you're going to have to get your hands dirty, and you're going to have to look at cash flow, and you're going to have to understand it, and you're going to have to understand, financing risk and rollover risk. And these are things that, to your point, and you're right, those are new disciplines for a lot of management teams at portfolio companies.
Mm. And I was taught at school that, commodities price themselves to the lowest variable cost, right? This isn't traditionally, unless you've got a sharp rise in prices, actually as a business, it's a relatively low return business in terms of assets, right? Whether it's a terminal or pipeline or whatever, because, these things price is commodity. It prices to whoever's got the cheapest stuff. Yeah.
Right. Or as we say in the trading business, it prices to inflict the maximum amount of pain.
Yeah. So again, it's not like these are traditionally high EBIT businesses where you can have the sort of what my former chairman might say, the candles and pillows in the office.
Right. Exactly right. And the reality is that in a business like that, unless you can take a bet on price in some smart way and or lever that bet, you're not going to make, high returns. That's the reality.
So I guess this moves us on to kind of the ugly, and I won't name him, but a friend of mine is quite strident in his belief that no one has generated income, free cash flow, from actually drilling or fracking in the shale, which he extrapolates that forward to there is going to be potentially huge losses in that space. The reasoning is that essentially back in 2007 or whenever it was, the public markets were compensating the producers, public companies, for production. So share prices were closely tied to increases in production and commensurately also increases in proven reserves or reserves. And along came this new technology, fracking, and private equity was just getting going at the time in this sector as well. And it was figured out and some of these very early entrants have made an incredible amount of money. They would come in, they'd buy acreage, you'd put a couple of test wells or wells there, and you would essentially find your lowest break-even cost on a well and find your best performing production-wise well, package that up as a deal and sell it at a huge markup, huge multiple to a public company. And that was the gig. And obviously, there's been just an incredible amount, hundreds of billions of dollars invested in that particular sector to the point where, I don't know the precise numbers, but, 12 million barrels a day production in the US forward to 2018. And there are starting to be some pretty public rumblings about, is this actually a real market? Is, Bethany McLean's piece, to mention a couple of one, with the argument going that actually, when you unpick the numbers, drilling or fracking is not itself economical. The cost of production is much higher than expected because of high variable costs and the service providers increasing prices to meet the oil price increases, and also production being much less than expected, tailing off much earlier or not even reaching the predictions. And there's a question mark there that because of the incentive structures in private equity, both in terms of holding on to people's money, but also flipping to get the carry, no one was perhaps, I guess, acknowledging that there was quite a mismatch between what people were expecting in terms of returns and what was actually going on.
Yes. Well, look, I'll comment on the opening statement, which is a thesis which I don't have a good counterpoint for. I'm sure that if you looked at that business in total and you looked at the production and the amount of debt that's been attached to it and the commodity price, like what have we got, $150 billion worth of debt attached to shale, something like that, and you look at it in total, I suspect the returns are close to zero. So I wouldn't disagree with that thesis. I'd have to check it, but I'm sure, there are again ventures that have made money, the early adopters, and then the followers who simply haven't, and all they've done is blend and extend the debt, and the company has kept drilling holes and drilling holes and drilling holes because the decline rates are so steep in shale that they probably actually, when you count the interest cost or the cost of deferred interest, probably haven't made any money. And so, it's probably right. But the reckoning will come, and it's probably on its way right now, given what happened in the first quarter of this year with oil, dropping to negative prices, if you believe the futures markets, and not really recovering that well. So you hear lots of mythology around what the break-even price of shale is. Obviously, it varies from well to well, but it's certainly not much lower than $30, if that. And so my guess is we're going to see a lot of restructuring activity, which essentially takes that $150 billion of debt, if that's the right number, and basically resets it. And that's what's going to need to happen. And unfortunately, limited partners who've invested in that are going to take some losses.
Mm. I mean, there's a couple of things there, isn't there? One is not just going to be the limited. I mean, if this thesis is true, and my friend mentioned that, I think his point was that even if oil goes to $70 or $80, actually all that margin ends up going to the service companies because they're the ones in short supply, and effectively can charge what they want. And you need so much more of them than anticipated, to put it simply, because of these quickly declining production rates. But not only is it going to be the limited partners and, God forbid, Houston real estate, but it's going to be the banks as well, because the banks have come back in, have been heavily participating in this sector again in that hunt for yield, and presumably trusting the fund's prospectuses on the acreage that they had.
Right. And they've been lending against reserves which haven't materialized. And they had to revalue those at the end of Q1 this year. And I've seen data on some of the curves that were in the models used to evaluate the reserves, and they're way too optimistic. And so that's, they may have been able to postpone the reset from Q1 to perhaps Q3 or Q4 this year, but unlikely to be able to postpone it forever. And at some point, there's going to have to be a reset. And we've seen a ton of oil restructuring, oil company restructurings, and we're likely to see more.
Because of the nature of private equity, and I don't mean to suggest that private equity are caused all this, but it's interesting that you kind of have this because of the covenants that they put in place with the limited partners. Firstly, it's very difficult. I don't, unlike a hedge fund, I don't think the limited partners can get their money out in most circumstances. And it's in the private equity firm's interest to hold on to it, because that's probably right now their only source of income from the management fees.
Unfortunately, yeah, that's where the incentives start to diverge, where you have a portfolio that's in a loss position, but if it's redeemed or exited, then the fee structure changes to the GP. And so that's an unfortunate divergence of incentives.
I mean, if you follow this through, the slow drumbeat in the background is you could end up with a situation where if actually shale is either the oil price never recovers sufficiently, or actually you've got effectively what's going on right now, which is private equity for the most part stating it is no longer going to be a source of capital to that sector. And there's question marks over the economics of it. Actually, it's even worse, isn't it? Because all this acreage goes to zero. Well, it goes to farm value, which is, going to really exacerbate the issue.
You're right. Capital will, as this starts to unfold further, capital will flee. But there's one silver lining, and it is in that acreage you can always construct renewable energy. We're seeing instances where you can buy royalty streams from solar and wind that is on the same land that's owned by oil companies for shale and other oil extraction. So there's a reuse for that land, but of course you may be able to attract capital to the renewables, but not to the oil.
Because there has been already, and it's arguable whether it's, I guess, ESG related or whether it's actually just, it's been a really painful sector for these private equity firms. But lots of them, the big companies, have already stated that they're no longer going to invest in hydrocarbons.
Yeah. That's going to make it hard to restructure the debt because, you've got people that are holding the debt that won't want to become equity holders. So, and then how do they pass their equity holding on to someone else when there are no other buyers? So I think the proposition for restructuring is going to be tough, because it's one thing to own a piece of debt where your downside, under most circumstances, is largely protected, to then swap that for an equity position where it can go to zero. So that's going to be a really tough process.
I'm trying to cheer ourselves up, but looking towards the future, you've got banks and probably now private equity. Maybe we're looking at a very small lens, I guess, of the global commodities sector. But in general, you've got ESG headwinds. You've got these big losses recognized or about to be for banks and private equity. What is going to be the new source of funding for this sector? What's the future of private equity and commodities first? And then if not them, will we see other sources of funding? Where could that come from? What do you think sort of the lessons that might have been learned and the future of alternative investment in this sector?
Well, actually, if there are less people chasing yield, you won't see the compression and therefore the abdication of proper risk management, because the yield will reflect the risk, which it probably hadn't done as everybody was chasing it. And so I still think that you will find capital that will invest in this, but the risk will be priced better, and it will still be private capital because there are still funds out there who understand this and understand the economics. And as everybody exits, there will be those contrarians that want to stay in. So I do believe in that model of human behavior.
Because there is, I don't know the numbers, but last year, $2 trillion worth of unused investment sitting on the sidelines still, right, out there in private equity. So there's a lot of money out there.
Yeah. And actually, as a setup, if you were to be the stalking horse bid in a restructuring, and you were to own equity in an E&P company for some minuscule amount, that would actually be quite a good trade for a private equity company to put on.
Because frankly, the reasons why it's been good business still exist. It's not like the tax advantages, paying capital gains on your income has gone away around the world in the various jurisdictions. And it is still a much more nimble source of investment for what is a fast moving market globally.
Right. And it's like everything. And I always say there's always a price that makes it work.
And I think perhaps the ultimate lesson is, and we said this off air, or you said this off air, is everyone had the same trade.
Yeah.
And that was the fundamental issue with shale. It ended up becoming.
That's one thing I learned at Citadel working with Ken Griffin, is to beware the crowded trade. And I'm not sure everybody else in shale did that.
One of the interesting things about perhaps the coming renewables, we had David Fernandez on from Goldman Sachs on a previous episode talking precisely about this. And in solar, actually there's much less complex business, right? In wind, particularly solar, and even some of the other green technologies, that don't have such your production is just tied to ambient sunny days, as opposed to very complex engineering that may or may not pay off.
That's true. And on the face of it, you're right. It's less complex. But in my interactions, one of the blind spots that I've noticed is an appreciation of how the nodal pricing works in the power market. And unless you understand nodal pricing and congestion, you can lose money in renewables by simply siting your solar farm next to someone who's just about to install a battery and creates congestion, which means that the sun can shine all day long, but you don't get to supply any electricity.
So the same principles apply, and not to make a pun, but it's actually in this sector, like all sectors, that you do need that expertise there to talk about the risks that may not be captured by traditional finance models.
Exactly. That's exactly right.
Well, it's been a really interesting discussion, somewhat bleak for someone who lives in Houston.
Don't worry, it will come back.
It'll come back, yeah. The bumper stickers here, dear God, just have oil at $80 again, one more time kind of thing. But anyway, it's been a real pleasure to catch up, and look forward to having you on. Do you want to say a word on where people can find you and your business?
Yeah, my business is TDI Capital Advisors. I operate out of Bedford in New York. I'm part of a bigger firm called TD International, which does third-party due diligence and compliance work, and also some very complex strategic advisory and investigation work for large corporate clients and family offices. Very interesting business.
I guess that's why we had you on to talk about this subject. So, well, thanks, David. It was a real pleasure.
My pleasure too. Thanks for having me on.
Thank you for listening. If you enjoyed this episode and want to support the show, please give us a positive review on Apple Podcasts or Spotify. To find out more about HC Insider and Human Capital, a search firm dedicated to the commodities sector, go to www.hcinsider.global, where you'll find more original content on the commodities sector and more details on our offering as a search firm and our locations around the world. Thanks again for listening.